Okay, guys, today, very special guest, Nick from Derive. So, Nick is building the preeminent options, decentralized options platform, has a lot of experience in options, was previously an equity options trader at SEG. Yeah, so welcome, Nick. Give us a little just tidbit about your background. I know, like I said, you were at Susquehanna and you decided to build decentralized options. What was sort of the transition there?
Yeah, thanks for having me on. And I've been into crypto since 2016, following along from, the ETH DAO hack days. And I was an equity options trader at SIG and saw firsthand, was trading throughout the pandemic and GameStop, saw firsthand all of the ways in which people used options to just massive amounts of demand for these products. And I always believed in an on-chain financial system becoming where, the rails for finance in the future. Because options are so flexible and powerful, I thought they were the most programmable financial building block. And so decided to take the leap in early 2021 to go build, the biggest source of liquidity for options and these building blocks on the most programmable financial rails. I thought this was all going to come together by the end of 2021. It's taken a little longer than that to pan out, but we are certainly, I think, getting there now.
Yeah. Okay. So, briefly explain to me the history of options. A lot of my context was early on, like Bitcoin miners specifically, were using options to kind of hedge out their risk. Like they have, fixed costs and they can use these financial products, and they could get very customized and, sort of structured products around what, they may expect to mine, electricity costs, all this stuff. That I guess was what sort of propelled Deribit initially,
Yep.
But correct me if I'm wrong. So yeah, talk to me about maybe where options began in crypto and then now where they are and maybe where you see them going.
Yeah, totally. That's about right. Deribit really started first doing volume in 2020. And then, as the market grew, they grew with it and did a really good job of attracting liquidity. And, liquidity begets liquidity. I think options markets are always the last vertical to mature in finance. They come after dated futures or perpetuals. They come after spot, obviously. And what it requires to get to get an options market going is these structural traders of options. So in crypto's case, the miners were the first structural traders of options. They would buy downside. A lot of them were kind of degenerate. Some of them sold upside. Some of them used Bitcoin to sell downside too to generate yield. So it was kind of like this two-way market where some were hedging, some were generating yield, and that creates liquidity as market makers flood in to take the other sides of these trades. And the market kind of develops around effectively these really big players and institutions who have a structural mandate or kind of business case around an asset that they have to work around. So for miners, hedging downside. For a lot of funds, as crypto has progressed over the years, a lot of funds are exposed now to ETH. It's kind of like the second big asset. We're seeing hype emerging as the next asset where you just have this big set of players who have mandates attached to, some funds are trying to outperform Bitcoin plus 5%. Some are trying to, outperform ETH plus 10%. Some are now holding hype as a core part of their balance sheet. You need these sophisticated holders who are just holding long-term and looking to make trades around an asset to get exposure in the way that they want, to generate yield, sometimes to hedge, or sometimes to take a directional opinion in order for options to really take off. It's why it struggled in crypto for a while is because there's been so many garbage assets out there that people are looking to flip in a month or two. You can't develop an asset a market around one event, which is often TGE for a lot of these tokens, or a big unlock a year after TGE. So really, I think it's just taken time for those assets to develop. And then the other tailwind we're seeing for options, now generally is just the higher quality assets, one, that are emerging from on-chain native teams, and two, higher quality assets from RWAs that are becoming available on chain.
Yeah. Okay. So you guys started in 2020?
21.
Okay. So you're initially part of the synthetics ecosystem. That was Lyra. Is that correct? Go ahead.
A lot of people thought we were a child project for synthetics. We never were. We were just kind of involved in the ecosystem. It was a separate thing.
Okay. So that's how I at least knew you initially. What was the progression from there to now? Derive, it's its own chain. Would you call it L1? It's a role. How do you describe it?
Yeah, it's a app chain. Okay. So
app chain.
L2 OP stack.
Okay. So what was the progression there? What were some of the difficulties you found there, and then obviously what then propelled you to where you are now?
Yeah, so the first thing we tried to do was like an AMM on options, which kind of like it sounds extremely crazy now, but at the time it was like almost impossible to even get our heads around any other architecture in a world where gas was like infinity back in 2021. It would cost like $1,000 a trade if we were on L1. We were actually the first team to launch natively on L2 and Optimism in August 2021. We got on the whitelist, like second or third behind Synthetics and Uniswap, and launched the AMM. And so the way that worked is like, there was some basic math around like adjusting the volatility in the surface and unified liquidity among strikes and expiries. It actually worked. Like it made, like, as crazy as it sounds, because there were like really no other options venues, we got a lot of good flow, and it made like, some of the AMMs made 5-10% over a year, like with a big track record. Problem was it wasn't capital efficient enough. There was no like margin, not any flexibility. It was a huge headache to like launch any new markets. So after like a year and a half of like doing with that, fiddling with AMMs, we decided in 2023 early that we needed to launch like an app chain with an off-chain like matching engine where, the protocol and the on-chain logic ensured self-custody. It had all the margin settlement and clearing rules, as well as liquidations, and then, high performance off-chain order book plus like an integrated RFQ. And we made that decision in early 2023 and launched, the chain, the app chain, because we need a lot of block space for these crazy margin calculations. We didn't want to compete on like a generalized L2. We then launched that version, which is kind of like, kind of the genesis of this version today, 2.5 years later. It's about, the same thing, modular being upgraded. But our vision for the app chain is not like, hey, we're going to do all the finance on the Derive chain. We're going to do what we do best, which is manufacture complex derivatives and options and then export them to where the users are. So we have bridges out to, 7 or 8 different chains. It means we're tapped in for like Hyperliquid, Solana, mainnet Ethereum, Base, like all of these different ecosystems. We can kind of give their users like a seamless experience interacting and trading with Derive.
Yeah, I heard you make this comment about how when you guys were working within the OP stack, you felt that the idea was this would be like an aggregation of liquidity. And so I heard you say 2 things. One, maybe this kind of idea of where all the liquidity is sort of overblown, which I think has been proven to be true, especially as we throw out a lot of terms like composability and bridging, like as it becomes easier and more seamless, this idea of like locked liquidity maybe is not as important as it was in the past when there was a lot of friction and maybe like some moats around where liquidity rests. That was one thing I heard. But I also heard you make a comment regarding thinking that the super chain, right, was going to be this huge aggregation of liquidity, and that didn't really play out. I'm interested to hear your thoughts as to why you think that didn't play out.
From what I've heard, it's just like a really difficult technical problem to solve. And I think it just got scuppered by that. Like the technical problem became almost insurmountable and the timelines just kept getting pushed back and back. And that was definitely a big part of why we wanted to do an app chain in the first place. We wanted that seamless interop. I mean, for example, standing up spot markets on Derive chain is extremely expensive. We don't have great spot liquidity. Our options of Perps liquidity is great, but spot is capital intensive. We would love to have tapped into Uniswap for that, but we couldn't do it because of, the interop never came. I think it was mainly technical difficulty. And then also, the enormous incentive coordination problem that Optimism ended up having with Base doing so much of the volume relative to everybody else.
So when you say the interop problem, just like not to zero in on this too much, but when you say the interop problem, you mean within the super chain? Like, because ironically, when maybe if you're thinking of interop just at a high level, it's often not within, like between Optimism and Ethereum and Arbitrum and Ethereum. And like, we're thinking maybe more within the context of the L1 and L2s. In this case, it's actually within the L2 itself. The interop was a very difficult technical problem. Is that correct?
That's right. And it's not just like bridging and it's like seamless interop, like atomic interoperability,
right. Which is what you would want, right?
Yeah, it's what we needed for a lot of the functions we wanted to build into the protocol.
Okay, so now you're an app chain and you use Celestia DA. Is this correct?
That's right.
Got it. Yeah. Okay, so then let me move a little bit to like, we talked a bit about Deribit and the success there. A lot of options. So I've talked to one other options guy and from Cumberland, and I think that my understanding with him is he's not like the technical guy, and I don't think he's really structuring this. He's a bit more on the sales side. But my understanding with a lot of these options and like how they're structured is very sort of bespoke. And a miner may come to you and have like some very specific, things they want, and then you can kind of design them in a way such that it's like a structured product for them. It seems like you are competing against these OTC desks in some capacity, but at the same time, we'll talk about this later, this RFQ system that hopefully can allow you to kind of customize things. What is the idea? Yeah, go ahead.
No, finish your.
Okay, no. I was just like thinking, like, what is the idea going forward? Is this, who do you view as your main competition? Like these OTC desks, centralized exchanges, other decentralized exchanges? I mean, it's obviously some combination of all, but I'm kind of curious, like, if you had to rank them or look at who your first addressable market is. Where do you see this?
Yeah, very short term. Definitely, you've nailed it. I think it's like in the OTC desk space. It's a weird one because we kind of have a working relationship with a lot of the OTC desks too, like because they're the ones quoting on our exchange. But we're trying to like these OTC. There's a huge OTC market. It's actually where like upstream of a lot of the flow that hits Deribit, because that flow that hits Deribit is like these dealers offloading risk,
laying on
from OTC. But a lot of the recent growth that we've seen has been around like a concerted investment in like building liquidity behind the RFQ. Since really like October, November, we switched our focus to really focusing on making that product excellent, along with a couple of great hires who've helped us do that and make it more institutional. And people and big OTC takers have started to notice, primarily through the hype options markets that we launched, because they're kind of unique. They're the only place you can kind of look at screens and trade hyperliquid options liquidly. And so that helped us kind of like get introduced to some of these big OTC takers for the first time. They realized there was more liquidity than, sometimes they kind of had us pegged for, and then kind of tried out Bitcoin and ETH and started getting great fills. And for us, like the experience for them is kind of better, because once you have these positions live on Derive, you can trade around them. Like you can hedge out when you want to on perpetuals. You can close it and get 5 market makers in competition versus being locked into your same OTC desk. You can use different forms of collateral. You don't have to lend all your collateral out to your market maker desk, which is a big problem. Like, if you look at block fills that went under like two weeks ago, that's a big Chicago-based US, regulated OTC desk, and had, I don't know, allegedly 4x the liabilities than the money on their balance sheet. We can do this all self-custodially with verifiable margin, and you add all those things up, and it is, it's a compelling value proposition for these takers, and that's what we found has been landing hardest in the last couple of months.
Yeah, so give me the inverse of that, in the sense of like when these people who do want, like, let's say they're skipping an OTC desk and want to come directly to Derive, what are the problems or concerns that they have? And like, for example, one thing, and this isn't relevant to options so much, it's just sort of the viewing the progression of crypto, and a lot of the things that we thought were obvious end up being much more complex, especially when integrating with the real world. Like I talked to a guy who's doing lending, just like straight lending, and I always, I think a lot of us operate under this assumption that the most efficient markets will be like functionally peer-to-peer. So the idea of non-custodial lending is like, oh, well, you should always find the best rates. It should always, like, the most liquidity should converge on something where there's less intermediaries, and that will be the future of lending. But a lot of these firms have all this red tape, but not just red tape. They're concerned about smart contract risk. They're concerned about understanding like the complexities of what's going on in the background. Like, some weird ADL wipes off a position for somebody, and they may not have understood that so well. So they have to put in a lot of work to understand these protocols. But my point with the lending thing was that, ironically, like a lot of these firms still prefer like a custodial lending model, and they'll give much better terms, right? Like to borrow against Bitcoin or something if it is custodial, which in our minds, like coming from this, decentralized everything or whatever, it seems like it shouldn't be the case. What have you experienced with some of the people who do maybe want to, enter into options contracts? Like, what have you experienced are their concerns? Like what do they see and say, we just can't work with this yet?
Yeah, a couple things. One, it used to just be we were on chain full stop. That blocker is like a lot lower now. I think Hyperliquid's actually done a really helpful job for us in the way of like, they do so much volume on the perps that it's forced a lot of big firms and takers to figure out how to trade on chain and get the right structure and like do the work to get it set up. And we're kind of like the next stop for a lot of those firms because, you know, they're trading firms. So you could either go to like the second, third, fourth perpetuals exchange, or you could look to a new category that you can kind of trade on. So it's helped us help clear the way for some of those blockers. Another one is custody. I agree with you. Like, it's important to support, you know, some people love self-custody. Others don't want to take the career risk if there's like a huge hack or something like that. And I'm a pragmatist. Like, we have a new product that we rolled out like a couple of months ago, which is, I think, a first of its kind, where effectively, you know, big takers or traders can keep their funds in a qualified custodian. It's like bankruptcy remote. Those funds aren't double pledged. There's a tokenized representation of those funds that gets minted via like a tokenization partner, and you can use that to trade on Derive. So like, you know, you can post Bitcoin, you can post USD, you can post ETH. And like, that is kind of like the compromise in the middle ground for a lot of these firms that is starting to move the needle for some of these big takers. So those agreements and those, you know, relationships are underway, and it's still like a lot of, you know, big, expensive legal work and grinding, but we're almost there for a couple of these deals coming through.
Yeah, that makes sense. You mentioned the Hyperliquid. You mentioned Hyperliquid as sort of like just, you know, for a forcing function almost, and seeing just how much volume and liquidity and activity. You guys also did something recently where there's an integration or something with Hyperliquid. What was that?
Yeah, that was us launching Hyperliquid options, and you could keep, you know, effectively keep funds on Hyperliquid, and we were like integrating K-Hype as well at the stake type collateral. Yeah. And it was, you know, kind of something we did in concert with some of their team. It's a kind of like new financial product within the ecosystem, something else to do with your hype. And that was effectively the launch was, you know, a few months ago, the Hyperliquid options.
Yeah. Talk to me a bit about like the design of the Derive chain. I know you were, so I heard you talk about the kind of like the portfolio margining, and just, you also have something not exactly like HLP, but maybe somewhat of an analog. Yeah. If you could just like talk a little bit about that.
Yeah, we don't really have like an HLP analog yet. Okay. It's a little bit more. We do have vaults, and vaults are going to be like becoming a major part of the system, I think, going forward for our growth. The way the chain works, it's optimized to like essentially do a lot of this heavy compute on chain, so that, you know, you have verifiable margin and like trustless margin, that everyone gets the same set of rules. It's like in the smart contracts, you can, you know, everyone can monitor and look at like the, you know, the various positions that are on the exchange. So that, you know, for portfolio margin or cross margin, cross asset collateral, like, it takes a lot of math. Again, that's kind of what we've been focused on building out over the years, and that's why we chose the app chain. I do think there are like certain issues with running an app chain or having an app chain that are, you know, starting to cause some blockers in terms of like ease of integration, speed of integration, some of the cool stuff we want to launch. So we're actually working on a little bit of a re-architecture for certain parts of the protocol to preserve all of like, you know, the existing integrations and backwards compatibility, but it should dramatically reduce the time it takes to integrate on Derive. So that's kind of underway at the moment. I can't say too much about that though.
Okay. But out of curiosity, when you say that you've run into like some slight blockers with an app chain design, what does that mean? Well, like, I guess to the extent that you could talk about that, like what are you implying there?
Yeah, so there's like decisions that were made in 2023 to deliver like a state-of-the-art UX. So things like having smart contract wallets enshrined is like, you know, kind of like the port of call for every dollar of capital that comes onto the chain. Because at that point, you can then do things like gasless transactions. You're clicking around. It feels like a centralized exchange. You can now do that without that architecture. And the problem with that architecture is it causes a lot of issues for people building, you know, integrations, both front-end integrations, vault integrations, market maker integrations. Like, that step is, there's like just a lot of logic that has to be kind of worked into any integration to handle and accommodate like that step. And it's now like, you know, for the where we want to go, where like we just want people building and distributing financial products, structured products, vaults easily. Like, we need to get that integration time down from like 2 to 4 weeks down to, you know, as soon as one click, like as easy as one click, or like half a day of work if you want something a little bit more involved or fancy. And then, you know, for market makers, taking that integration time down, you know, by weeks or, you know, potentially, you know, months, flips the calculus for them in terms of like, okay, do I integrate with this venue or do I not? And so it's actually like kind of, we're redesigning parts of the system to make vaults and integrations like a primary user of the system alongside click traders, and alongside market makers. So that's a big part of the re-architecture.
But okay, so just like a little, explain a little bit more in depth, or maybe more simplified. When you say the app chain aspect, do you mean because it's your own proprietary app chain? And could like compare this with, I don't know, like being part of the super chain. You're saying that it requires like more understanding of your specific code base as opposed to, say, you were, I don't know, on some other platform where it's already easily integrated. Is that the idea? Like there's custom logic that if you want people to build on top, that this is becoming somewhat of a blocker because you went the app chain route as like your own proprietary chain. Is that the idea? I know it sounds to answer that, but I just wanted to clarify.
Yes, it's more like the decisions we made to support great UX on the app chain for click traders. And like those are related to being on an app chain. It would not have been possible in 2023 to build a fantastic experience like that on an L1, but I do think it's potentially possible now.
When you say click traders, is this like a nice way to say retail?
No, like just anyone accessing the UI.
Okay.
Yeah, anyone like who's actually trading through the UI, which has retail has not been our focus and probably and likely won't be for some time. Again, our strategy for that is primarily around attracting people to come and integrate and build front ends and appeal to retail in their local jurisdictions. Like that's exactly what we want, because that's not a skill set as a team. We think there's a natural equilibrium between like our economics and their economics at scale too, because I don't think many people are going to go out and build an options exchange. It's just too difficult. It takes too much time, and the network effects are very strong.
Yeah, that is interesting. It seems very much, I don't want to say B2B. I think it's a little bit condescending in this environment, but yeah. So to that end, obviously like perps are huge right now, right? And I think that, yeah, so maybe like you think that like options are kind of like the last of the financial products, whatever, to be built out. So like maybe we've now seen the progression of perps. Perps are fairly retail focused, and one of the claims you hear constantly, like from our friends who are big into the perps, like Jazz and Flood and these guys, right? Like they constantly note that perps are just a much more intuitive way for retail to express leverage. I guess the first question is, do you agree with this? And then maybe a follow up, if you want to just keep rambling, two-part question here is, do you think that this will continue in the future, or do you think that there is a way to, I don't know, simplify options? We already see it on Robinhood, which we can get to in a bit, but for retail, that they'll be interested in the future, to maybe use both.
Yeah, I mean, I think the volumes both on zero-day options and traditional finance, I know they don't have access to perps, but also now the increasing volumes for some of the binary option stuff that's happening in prediction markets is indicative that people want other forms of leverage, like, and particularly retail too. Like it's not just a slider that can go up and down. I think a lot of people got disillusioned after 10-10 because you can do everything right. You can even be delta neutral and still get ADL'd and have a path dependent type of exposure. I don't think it's a huge leap to go from like, you're seeing these binary option up down markets in 15 minutes starting to take off. I don't think it's a huge leap to go, hey, I'm going to put up $10. I'm going to make $10 if Bitcoin's above 75K in the next 15 minutes, to go from I'm going to put up $10 and I'm going to make $1 for every dollar that Bitcoin's above 75K in the next 15 minutes or in a day or 2 days. Maybe perps, kind of like eats into some of that market share, but at the very least, the retail volumes for options will not be zero, which is currently where they are. So I think it's like, up only in terms of the market share for options. I don't think they're crowded out by perps. They're just fundamentally different products. So that's kind of like my short-term take on retail. Again, it's not something that we as a team are going to like focus on solving, but we think we can provide an instant backend for someone to experiment and like solve that economically now for the first time, because spinning up the liquidity and doing all of this work is just a very difficult cold start problem. So if you can take that and focus on distribution and the right form factor and the right, targeted advertising, I think that can work really, really well for somebody. With respect to like options versus perps and like bigger picture outside of just retail, I think like that is clearly like, if you're just sort of the perpification of everything argument, I just do not buy at all. Like it sounds like someone who has bags just talking their bags, and like I am someone who has bags and options, so like you can take that with a grain of salt, but like there's a reason options are so big in traditional finance. It's not because none of the institutions have access to perps, it's because the flexibility and the power of options, you can win a lot more. First of all, for speculative reasons, you can win way more if you make the right options bet versus if you make the right perp bet. Like no serious institution, like you see this thing happen in tradfi where like short sellers write a short report and they come in before the short report goes live and they buy a ton of puts on, on the name that they're going to go short. There's a reason they take that position in puts versus in futures. One is because you can get way more leverage. Two is because if the short report's coming out in a few days, there's a chance that if you want the leverage that you really need from this bet, if you want like 30, 40, 50x leverage, you don't want to take the risk that like the stock goes up, 2-3% in the next couple days and you get completely taken out of your position.
Legs before it even comes into fruition. Yeah.
Yeah. And that's not even to mention the yield generation stuff, which is really the bread and butter of options. You can't do that with perps. The funding rate is, fluctuates. There's a ton of things that you have to go your way or that you have to monitor and make sure you don't get liquidated. The funding stays in place. And you can't really do that with, the wide long tail of assets in the way that you can with options. You can instantly imbue any of these assets, even top 200 coins with functionality and yield, capabilities by trading options. You really can't do that with, as collateral for perps. So this is like a lot of reasons why there's a big market for both in the future. And I think perps are a great product, but and certainly great form factor for a lot of use cases. But the perpification of everything is just nonsense.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.com/careers. Yeah, what do you think about this like tap trading thing, right? This is like a version of options. This seems like a way, well, it's like one very accessible way for retail. It looks like extremely degenerate, but yeah, I mean that is right, like options in like a very reductive form, perhaps. But that is one way I can definitely see retail like clicking buttons, and like little squares. So go ahead.
I would disagree with you. I like Euphoria. I think they know what they're doing, right? Like, and I've met a couple of people from that team, and they have a cool, great at UX and whatnot. But kind of the feedback I gave them, which I think is correct, is like you could just replace like some of them are like 5-second markets for like ETH up down. You should just replace that with like a dice or a random number generator, and then it settles up or down based on that, because you don't have to go through this whole rigmarole with like options. And like maybe there's something with the retail psychology, because I'm not in like this sort of iGaming space.
Wait, you mean dice like purely randomized?
Yeah,
and like totally. Just scratch the options altogether.
Yeah, like why not? Like it saves you all this like headache of trying to explain options and build up liquidity on the back end, and it's a lot cheaper, and you can kind of prove that it's like in the same like random price movements, random walks collapse to just 50-50 on that time frame. Like what's the point?
Well, I think that's kind of interesting. Like, of course, you're correct. The expected value is the same, but I think that what it is that I think people who walk into a casino in Vegas know the house wins, and maybe they have like some, like I think for the vast majority of people, you can't really, there's like some predatory practices, but for the most part, like these people know they're losing. They know it's for entertainment. I would say that's not actually true with a lot of participants in crypto, which I honestly, this has changed my mind. I thought people generally realize that if you aren't at the top of the funnel in like a cabaled meme coin, you're getting rents like an expectation. Like you were getting rents way, way more than the 2 or 3% edge that the casino wins in blackjack. But I think that people think they have an edge. So these little, like you say this dice roll. Yes, of course, like we can sit here and realize that this is like very much the exact same thing. But the reality is like some very slim, maybe a lot of people think that this is more fair. Like they have some unique edge. And that's very much the case with the trenchers, right? A lot of people got rinsed in meme coins, but they thought they had an edge, right? They thought they were early. They were like 8th on the list of the cabals, but they thought they were early or whatever.
Yeah, I agree with that. I think that is the likely explanation as to why they haven't done that. But to me, that is what it like kind of devolves into, like, which makes it not really analogous to options. Maybe they will get into options in the future where that time horizon extends out. I'd love to work with them on like liquidity and backend stuff. As I said, I think they're a great team, but I think that at the moment, like that version of the product is a lot closer to iGaming than it is to options.
Yeah, no, definitely. But I think also a similar thing would be like, I don't think you could convince all the people buying 0 days on Robinhood that they should just go play blackjack instead. Like you know what I mean? They should.
Yeah, you're right.
But they wouldn't. That wouldn't make sense to them. They think some Wall Street bets guy has like some unique, foresight on AMC or whatever, GameStop. So I think that is weirdly enough the difference, even though, yeah, it shouldn't be. Okay, I wanted to like move a bit now to value capture, I suppose, from, or how you see this from a platform, a protocol. You want people to build like front ends for this. Robinhood makes a lot. I was actually very surprised recently reading a report. A lot of Robinhoods and like by extension Citadel, they actually don't make a lot of money on just like a spot equity. They make a lot of money on options, and now kind of into these prediction markets. There's a lot more vig that can be taken there. How do you view it with regards to Derive, but maybe just crypto protocols in general? Like where's the take rate for kind of like each person on, is it the front end that accesses Derive? How much do you guys take? Is there a lot of juice to be taken? It seems like intuitively yes, because there's a lot in TradFi. So like, where do you view the kind of like value capture playing out, maybe, in the short and long run?
Yeah, I think this is fundamentally different to what a lot of people think. The common like line you hear on VC Twitter or whatever is something like, you got to own the end user. I do not think this is like a case of that. I think there's a reason that, like, for me, as I said, the reason we love this approach of being kind of like this liquidity network is because I think like there really is a stable equilibrium between us and like anyone who wants to build a business on top of us and distribute. And it's not they make all the money and we make zero, and it's also not we make all the money and they make zero. It's going to be somewhere in between, and you can scale that up in a big way. And the reason for that is just because of the strength of the network effects for options. It is why Deribit has managed to fend off in the centralized world, like Binance, despite having deeply liquid perps and a ton of balance sheet to throw at their options offering. They just didn't manage to crack into it. And Deribit is still like 80% of the crypto options market off chain. Although, we're taking some market share now in the last like 3 or 4 months. We expect to take a lot more in the next 6. And for us, like, we're 90% of the on-chain options market at the moment. If we can continue to grow that out in terms of like, not really worrying about like, the short-term fees or economics, once that network becomes established, it will be very, very difficult for other people to come and replicate that because of the lindiness, the slow-moving nature of a lot of the customers, as well as like the liquidity on the books. It just becomes exponentially more expensive to try and kind of wring customers and users away. So for us, like, we can get people integrated. We give them good economics, particularly, if they're integrating early and those things get locked in, they're bringing us flow. They're charging, and earning the majority of the fees. That's great. I think there's like a very stable equilibrium in the long run where we're earning a small percentage of the fees for tons of people. And there's no chance that they're going to move off of us, because even if you were, like kind of, hey, like we don't like giving up 20% of the revenue or something to Derive. Like, again, you would have your choice is either you go to, build your own options exchange from the ground up, which is not even a strictly like a money or resources thing at that point. It's just a very difficult coordination problem. Or you just continue and try and sell 20% more product or whatever it is. Like, I think there is an equilibrium in there. So we don't have we have fee tiers and we have integrator and broker programs. We're trying to be as commercial as possible with all that stuff because we really value people who integrate with us and like kind of take a bet on us now. And as I said, we're certainly not going to be in the business of, trying to like raise the rent on people or anything like that. I think there's just a natural like win-win here for us and all of our integrators in the future.
How much in TradFi has the ETFs like, and where are the options traded there, right? Because that was one of the big obvious changes, right? With like IBIT and yeah, all the options selling around that. Where does that take place now? And has that been like a pretty big dent in, well, was that a big dent for like Deribit, for example?
Yeah, in terms of like the overall market share, it's been a dent for Deribit. I mean, it'll be interesting to see what Coinbase does with it versus, like positioning it as like a direct competitor, keeping it offshore. It's not exactly clear to me what's going to happen there. But a lot of the, we know a lot of the activity. Like, I do think that like one of the large Hong Kong hedge funds was responsible for a lot of the sell-off, and it probably originated in IBIT options trading, which would have originally taken place on Deribit, but I'm sure some of that flow has migrated out now to IBIT. It's an interesting one because IBIT is still cash settled, so there are problems with it. It's not like there's no physical settlement. There's no like it's. I'm sure there's margining in coin now. Someone's probably doing prime brokerage across like your Bitcoin spot and IBIT options, but yeah, there's still a huge chunk of the market that is, can't access IBIT or uninterested, and Deribit kind of has a chokehold on that. But it's taking away, I guess, the signal on Deribit to some extent. And yeah, Coinbase will need to invest resources into competing with it directly, I think, long term.
Yeah. You guys have Perps on your platform. So was that there originally? I assume not, but what did you guys build that subsequently? And what was the idea behind that? I know you mentioned like there's ways to, use options and perps at the same time, right? Like so that going forward, you would be able to do that all on one platform. That could be helpful. But what was it? Yeah, what was the what was the motivation to build also the perps on there? And like how do you see the volume? Like do you see a lot more options volume, a lot more perps volume? Like what does that look like right now? Obviously a gajillion perps exchanges. That's why I'm asking and interested to see how much you guys are focusing on that or whatever.
Yeah, great question. So we've had Perps since we launched this version 2.5 years ago. You need a Delta One instrument, i.e., like the ability to trade, like the underlying asset with some leverage in order to facilitate liquid options markets. Because when you have a big options position, you have gamma, which means your overall delta changes as the spot changes. So market makers are constantly using perps, and we chose perps versus dated futures, which it is in traditional markets because perps have more demand in crypto generally. So everyone's set up to trade them, even though dated futures are a slightly cleaner hedge. But the perp volume and markets are there almost purely at the moment to incentivize, to allow market makers to hedge out their options gamma and their options risk. And that's great because that is an organic source of flow, even though it's coming from market makers. Like they have to get these hedges off and they're profiting on the options trades. So they're willing to give up some edge on the perps to get better margin on exchange, like reduce their margin requirements as well as, just hedge their, dollar position as well. So they're very symbiotic products. We're not going to go out there and try and compete as like the 15th best retail perps trading experience. It's not like what they're there for. I think you can, what you can use the perps for and Derive, they're actually pretty good now. Like really great trading experience if you were like interested in just click trading them. But really it's about like how they work together in your overall portfolio with our cross margin and portfolio margin features. You can borrow lend with some of your assets on Derive. You can, trade an option and then hedge it out with a perp. You can have a basket of options and perps, and you can make all of these funky structures with your portfolio that you gets you like way more capital efficiency than you can pretty much get anywhere else on chain. Yeah. So that's why and we expect those volumes to keep growing as the options scale up, and the liquidity will just get better and better.
Yeah, you spent 3 years, over 3 years at SIG trading equity options. Talk to me about like where are we with regards to? I assume you had the best tech and were trading on the fastest or most efficient platforms. How close are we? I say we collectively, crypto to like a TradFi experience, and maybe like, or are there any things that we're still very very far away from? I ask because right, like you do have, a lot of people didn't work in TradFi, didn't work at SIG or whatever, so they may not have similar like comparison. So where do you see like the how close we are, and then areas that are just still very far away in terms of providing like an institutional or like professional level experience?
We're close in some ways. I think liquidity is developing.
Yeah.
I think 24/7 trading is pushing traditional towards crypto in a lot of ways. I think there's a lot of great innovations around self-custody, programmability that TradFi is going to be forced to adopt. I think the main thing that I can spot that's just completely missing from crypto is any concept of prime brokerage that is, exists in at scale in TradFi, i.e., this ability to like look at all of your positions across many different asset classes and exchanges, having like a bank with an enormous balance sheet that's willing to say, hey, like we will extend you margin based on your collective book of positions, and then, kind of facilitate your margin moving between all of those venues, as opposed to, right now where you have to have capital on Hyperliquid, you have to have capital on Derive, and they're just kind of siloed. I expect someone is going to solve that problem in the next two years or so. And there are like kind of off-chain versions of this, like Hidden Road kind of do this to some extent. There are other players in the space, but no one's really cracked it at the scale or the competency that it needs to be cracked in order to really help grow the on-chain.
Remember this oxygen thing? I think that was the goal. It was oxygen. Like SPF. Like,
yeah,
on-chain prime broker or whatever. I mean, it was like quite literally just vapor, but it was, I think that was at least a problem recognized even very early on, right? So that's just reminded me of that. That's hilarious. Yeah, I didn't really understand. Well, that's obvious why I didn't understand this, but just the degree to which like trading firms have to have these custodians. Like I didn't understand at all that when you're trading, for example, like if you were working at a prop shop, like you have to have a custodian that really you basically give money to, and then they give you credit on like Binance or something. It's a very weird concept. It's like nobody's willing to just deposit this stuff directly. You have to have like these layers upon layers of insurance and like people who will put their name beside yes, and then you give them a little like scoop of the pie. It's like quite bizarre, right? Especially in the context of crypto, where it's like, okay, the idea was, disintermediate as much as possible, but then all of these trading firms have all of these like various, blockers just being able to interact directly. So yeah, that makes sense.
Yeah, it's not just for in TradFi, it's not really for the custody component. It's more for like the margin, right? Because then they have all these balance, and like, a SIG, has a prime broker, and like SIG are obviously going to make way more money on the exchanges than a prime broker would, and it's like kind of like the less expertise you go to like a bank that will do the prime brokerage, like Merrill Lynch or Bank of America, whoever, and they're not going to make tons of money trading options the way SIG does. And so like it's almost like like the returns get diluted up the chain, but then there's way more money up the chain because you have these banks that aggregate all this liquidity. I think like if crypto is successful and on-chain is successful, those tools will kind of like become more universal, accessible. That liquidity will migrate just from like all of the banks to kind of stay with people themselves. And you kind of invert, like that's why I love self-custody, because it inverts the power structure as opposed to the banks being able to like make these deals and make this money off of having masses of other people's money aggregated. Like in theory, like you should make money off your money. In some ways, like, this is like that financing, and those businesses are built off the backs of everyone who has, a savings account that, with money that's earning nothing.
It's like the little like turtles all the way up with little parasites. So, okay, like answer this however you feel comfortable, because I don't want your lawyers to yell at you. In terms of like the regulatory landscape, it seems promising, right? Even today, Hyperliquid announced this thing with, this is Wednesday, March 18th. Hyperliquid announced this thing with the S&P 500 to be their like have official indices being traded. So I'm only pointing this out to say that it does seem like obviously we're moving in the right direction. From your perspective, how is it like with listings? What do you guys list now? And the reason I ask is there's something about derivatives, right? Where because there's no underlying and you really just need an oracle, like it may be a bit easier compared to like offering spot, like you can't offer like spot Apple shares or whatever without the approval of a bunch of people and the regulators. So how is it like, so what are you offering now? And like, how is the regulation aspect? I know you guys are a protocol and you block US users, but what does this look like for you for the time being? Like, what are the big kind of blockers?
Yeah, we're not available in the US. We'd love to figure out a regulated path to getting into the US. As I said, I'm a pragmatist. My goal is to, be the source of options liquidity on chain, like the biggest source, and like these programmable financial building blocks. Like that's what we're trying to fulfill the end vision of. And like that will require, at least a regulatory strategy like that is complete. And so like for me, we're working on these things. We're thinking about them. We're still trying to, build liquidity and kind of have the conversations and figure out like the right paths into markets we can't access right now, and users we can't access right now. But if you like, and it's going to be a balance, right, between the benefits of the self-custodial, like on-chain model and like the realities of the world that we're trying to, to kind of like bring liquidity over from. So very much in flux at the moment. Like there's obviously a lot of information coming out. Hyperliquid doing great work on this too, not to just like shill them, but it's encouraging to see, people like Jake Stravinsky, who I know has, just joined a policy center that's going to, I think, kind of chart the rules for DeFi and on-chain applications within, the US.
So do you offer like just crypto options right now, or do you have
just
other
crypto options? We are eyeing up, a path into other asset classes. As I said, I think like we have the best stack to wrap around a lot of these useful assets that are coming on chain. So, it's definitely something we're thinking closely about.
Yeah, I don't know. Like, I'm very naive to this with regards to like options on like commodities and other real world assets. Do you think that you can break in there in the same way? I mean, obviously with crypto options now taking some like market share from Derive, let's call it. Do you think that the future is, options on everything and 24/7 trade? I assume that, their commodities are not traded 24/7, right, on the CME. So like how do you view that going forward, like real world assets? I mean, is there a big demand? Is there anything lacking in the like RWA space that you could provide?
Yes, I think one of our biggest unlocks is going to be things like algorithmic self-custodial structured products on top of RWAs. Like I think one of the big benefits of RWAs on chain is obviously 24/7 markets. That's the obvious one. The second one is like you can post your RWA as collateral and like borrow dollars against it. That's a big unlock for like lending protocols. We also support that. I think like the next, and like probably the biggest in my view, value proposition of RWAs is the like this like commoditization of like, structured product strategies in, using options as building blocks. There are all these things that, people love to do in traditional finance, all the way up to like the very top structured products desks that most people can't even get their heads around because options are a little bit complicated. And so what we can do is like tokenize, like in the same way that Athena tokenized the basis trade, we can tokenize various iterations of these strategies. So there's like a strategy called the wheel strategy that's very popular in Robinhood with equities. Like you can imagine a future in which, the wheel strategies, you sell some puts. If it goes below your strike, you get assigned, and then you sell calls, so like a much higher strike. And then when it goes through the call strike, you kind of like get exercised, and then you have to, you then sell puts again. So the other way around, actually. It's the other way around, but you know what I'm saying. Like it's like this kind of like accumulator way of like accumulating an asset that kind of is ranging. People love to do this. It happens in big size. We can tokenize it and show high quality execution, show a track record that's, verifiable on chain. And you can take these strategies and building blocks and, other people can come and distribute them. And I think like that's the kind of stuff that you just cannot do in an interactive brokerage account or Robinhood account that we'll be able to do. You could even take them and plug them into, some other part of a financial application that you have. I mean, who knows? But the whole point of it is tokenizing all of these trades and opportunities that are, being done at scale in traditional finance with layers and layers of middlemen who are pitching them with huge markups.
How important do you think something like Derive is to be composable with other chains? And so I know we kind of touched on this, but talking about like tokenizing these strategies or something like that, is this something that you want to be able to easily bridge to Aave chain or whatever? I'm just like, thinking in the future, is that something that you envision, like that level of composability, or is these type of like this product maybe is more confined to Derive chain specifically? Like how much does the composability elsewhere matter? Because I think with some things it does, other things it doesn't. Like the liquidity on Hyperliquid is fairly locked in, maybe for Perps specifically, and then they have their EVM stuff in the background. But some products feel like they need this like mass composability and that they can tokenize, and then others are, more focused on just being an insular sort of island or whatever.
Yeah. Short term, I don't think it matters. I think that will be the last piece. Once there's like super consistent liquidity, a big history of these trades being tokenized, and people just accessing them and using them. I think long term, it would be really, really cool. And I think other people, like, it matters a lot because that's how you get integrated into other financial applications on chain. But in the short term, like our vision and focus for those sorts of tokenized trades will be to allow anyone to create them and then distribute them like in as quick as a click, like, 1 click or half a day, as I said, if you have like more bespoke structures that you want to try and build. And I think that's like a very compelling business, right? Like, you can go and, as someone, you can create these, structured products that are upsold and upcharged at massive amounts of fees, the highest level of finance, and you can go and distribute that instantly, scalable, if you have the sort of like sales and BD chops, and like kind of how to tailor it to your users. And that's where I see like the biggest short-term benefit. Longer term, hopefully we can get some like put buying strategies as part of like decentralized stable coin that has exposure to ETH and Bitcoin. Like, that's the kind of stuff that I think like is interesting as part of a composable financial system, but the demand for that stuff isn't there today.
Yeah. Okay, the last thing is, you guys currently have a token, right? It's called the Derive token. How do you view this? Like, again, I know that there's probably regulatory constraints around what it can be or what it was in the past, but how do you view kind of like governance and maybe value capture going forward now or going forward?
Yeah, I can't really comment too much on the latter. All I can say is I did write a big post about this on X like a couple of days ago. I'll say that like the Derive token is the token that that's been part of the system for like almost like 4.5 years now. It's the same token. It used to be the Lyra token. We rebranded, but functionally it's the same one. Like, governance really does have it plays a big role in our system. Some big proposals that have been controversial have failed. Like, we have real governance, like there's real back and forth, and a relatively well, like, kind of put together community. Like, people have generally like a long-term time horizon. People who are active in governance tend to be, like kind of sharing the same vision that we have for DeFi, and like building throughout like multiple cycles and not chasing hype and things like that. I will say that like we've never raised money into like an equity entity. There's no like competing interests within the system. Like, we're all aligned around Derive as like the token within the network that we're building here, and of the protocol fees that get generated, like governance has the kind of like say over where they go. Currently, governance had voted for 25% of it to be bought back, and then 75% are accruing to like the on-chain insurance fund, which backstops the protocol, which is important. It's like the last leg of the waterfall before, watering down profit and loss and things like that.
Yeah. Do you find that or if you just had to say from a high level, is the Derive token are the holders more likely to be fairly sophisticated, maybe relative to, some random DEX or something? Like, given the fact that you do seem to be targeting a fairly sophisticated user in general, are the like actors in your system professional traders and funds, and like, is that typically who you want to be giving proposals? I guess I asked because we've seen, some fairly disastrous ideas from people who just, happen to hold a bunch of random DAO tokens or whatever. So I think like this is something that the space in general has realized going forward, that if you are going to allow a lot of input from the community or whatever, you probably want them to know what they're talking about.
Yeah, I mean, that's the reality of the setup. I mean, I would say, in general, we attract people with a long-term mindset. Like, and if this is a kind of like, I think people who have that short-term mindset of like, hey, like, do this dynamic for staking or some crazy like, change to how the token works. Like, let's do it right now. Like, those people, because they're trying to, maybe manufacture like a 2-month, 3-month style, like short-term outcome for themselves. They know like this is not like, we're not the community to do that. Like, it's just not who we've attracted historically. Generally, the discourse is very like even keel, level headed, and I would say like certainly not the sort of community for you if you feel that way. That's how I would feel like. But we've managed to, I think, find a good balance between continuing to iterate on the network and the exchange over time, whilst ensuring there's like accountability and governance has a real impact on what happens.
Got it. Yeah. Okay, well, this has been fantastic. Where can people find you? Derive.xyz, I know that. And then your Twitter or anything else you want to show.
Yeah, it's my Twitter is at itsnf phonetically, so it's ITSENEFF.
Okay, awesome. Well, thank you so much for coming on. It's fantastic.
Thank you for having me. Blessed to get on at the time where you seem to be blowing up yourself. So thank you for having me on.